Okay, so good morning, everyone, and welcome to the Macro Snapshot. We are Thursday, June the 12th, 2025, about 7 in the morning or so. Okay, so yesterday we got some, it was interesting data. We got the CPI, and a lot of people, a lot of market participants were trying to understand whether there was some sort of impact already discernible from the tariffs. Had tariffs caused prices to go up? But as you can see here, just from the daily shot, I've got a bunch of charts just showing that the CPI came in much lower than expected, which the front end of the curve liked, the dollar did not like. And the stocks were, had a relatively muted reaction. But as you can see here, looking at like the core CPI month over month, you see the survey and the actual sort of came in lower. So that was the good news here. You see that a lot of these sort of components here, if we go here, we can see that they're a lot lower than expected. So the market quite liked the headline number and the core number being lower. But what is interesting is really to sort of understand whether this is going to be widespread. And so, for example, some of the sort of effects were felt in things like, let's say, audio equipment, where there's a clear sort of tariff sort of premium being paid here. On the other hand, if you look at core goods, that was down a little bit. If you look at, for example, new vehicles down, new vehicles and trucks down, and then importantly, core services month over month, that was a bit lower than expected. And you see that seems to be trending downwards. If you look at the rent of primary residence, that also seems to be trending downwards. The OER, the so-called owner's equivalent of rent, trending downwards. So the point here is that quite a lot of good news in terms of the Fed. And we'll have to see, because of course, a lot of other people then are saying, well, hold on, there's lagged effects. So just in some of these charts here, a lot of the institutional research in the banks are basically saying that the true sort of effect of the tariffs will not come into maybe next month's sort of CPI and then even the following month. So it's one of these complex situations that it seems to have been sort of quote unquote good news, but we probably will need more data. And more importantly, the Fed will probably want more data before turning potentially a bit more dovish and cutting sort of rates. We shall see. On the other hand, there are some other things to be looking out for. So just a couple of examples. So you look here, for example, at airline traffic, and as they're saying, a historically reliable early signal of economic slowing. So often sort of a leading indicator of sort of airline traffic. You can see here that the 90-day moving average, you can see that that is sloping downwards. And then another thing which is interesting is this whole debate between the survey and sort of hard data, and this idea that the surveys. So you see here the soft data, which is the green one, which had sort of plummeted quite a lot, sort of March, April. It's come back a little bit. And people saying, yeah, that's just surveys, it's just sentiment, it's politically driven, it's not really important. And what we really will need to see is if the hard data actually catches down to it in the sense that it, sort of merges. And what we are starting to see here is that, if you look overall at the sort of the hard data, it does seem to be slowly turning over. We shall see. So putting that all back together, the point I wanted to make is that that seemed to be sort of a slightly sort of dovish result yesterday from the CPI. It looks as though it's just sort of slowly coming down. But the thing is, the market will need to get a lot more information about that and the Fed. And today we get a little bit more information, which is going to be kind of interesting this morning. We get the PPI. Now, keep in mind that this PPI is for the May period. And we know that in May that gas prices and sort of energy in general and crude oil prices were at a fairly low level. So that may be reflected in these numbers, which might be a little bit soft. And you say, aha, does that confirm the CPI from yesterday? And my point is that yes, but maybe no, because the fact that we've already seen in the last 3 or 4 days that the price of crude oil has gone up, which will then, of course, be sort of put into the forward, the PPI for sort of the June period. So it's a bit of a sort of a volatile number, and it is slightly lagging. But nonetheless, let's see what's expected here. Here are all the numbers here. The important one, of course, is as usual, is going to be ex-food and energy month over month. So that's one I'll be looking at. But just in general, we need to be looking out for those at 8:30. We also get at 8:30 the initial jobless claims. And just keep in mind that this is at 242,000 expected. So this number is definitely creeping up. And if we actually look at the 4-week moving average, that also is slowly turning upwards, which of course indicates a weaker demand. And just keep in mind that the highest number we've had for quite a few years, just coming out of COVID, I think it was about 264,000 from memory, about 264,000. So that's really what the market doesn't want to see. So let's just keep an eye and see, if this is confirmed at, 240 or even into 250 or 260. That would be pretty bad news. And I think then the stock market would start to feel some pressure, and definitely that the bond market, the front end of the bond curve would quite like that. Other one, of course, to keep a lookout for is continuing claims. And obviously on the back of that CPI yesterday, we did have some geopolitical risk. But if you look at the CPI here, you can see that the Fed, the one I always like to look at here is like for December 2025, we're now above two cuts at 51 basis points. And just to see how that's been moving over the last about 4 or 5 days, and you see how sensitive this is for data at this point, we can see that when we had the relatively strong jobs number on Friday, we're at about 54 basis points of cuts. So there's about two full cuts priced in by the end of this year, December 25. And you can see here that the market ripped higher in a sort of a hawkish repricing. And we got all the way up to about 41 basis points. So not even two cuts. And then suddenly, when we get that sort of slightly soft or lower than expected CPI yesterday, you can see how that pushed down and still sort of maybe stabilizing now. But basically, we had about 10 basis points of sort of dovishness repriced back into the market. And keep in mind that the magic number is this sort of 50 basis points here on the right, which is essentially two 25 basis points cuts. So I think really ultimately we're just sort of mean reverting around that number of about two cuts. And of course, as we all know, on the 18th of December, in 6 days next week, we get the Fed's updated summary of economic projections, which will either confirm on the dot plot of two cuts or maybe even slightly hawkishly, they might reduce that to one. We shall see. But if we had this slightly soft CPI yesterday, if we get sort of initial jobless claims going up today, and we get a PPI which is on the soft side, that could sort of start to solidify, at least in the market's mind, that the Fed definitely is on the cutting path at some point, maybe more like sort of in the autumn, like September, October, rather than June and July for sure. So that's something kind of quite interesting here. Okay, just in terms of other news, I'm just going to grab some tea. Just in terms of the situation with the sort of the tariffs, yesterday morning, Trump tweeted, a China deal. And he tweeted out some very confusing numbers that there's going to be a 55% tariff, and everyone immediately said, "Well, what does that mean? Is that?" So it's a complex situation where it seems as though there's going to be some kind of base tariffs. Certain things with China. Maybe the Chinese will export more rare earths, and the Americans will allow the exports of most of their most sophisticated computer chips. It's possible there's been some kind of quid pro quo going on there. We also had Besant yesterday in front of, I think it was the Senate committee, testifying. And he was basically saying that, at some point there'd be sort of universal, unilateral tariffs imposed. And, it was all a bit vague and wishy-washy. The point I'm trying to make is that I'm sounding a bit vague and wishy-washy because no one exactly knows. This seems to change every 3 or 4 hours. We even just had Trump this morning saying that within 2 weeks, he would be imposing a unilateral tariff. So just one level of unilateral tariffs, just the US on other countries. So it's all a bit confusing. No one exactly knows. But I think if we step back, the general sense is that Trump wants to sort of close this off and get on with things. And I think, probably we're probably going to settle on, who knows, about 8 to 12% on average kind of tariffs coming out of China and maybe Europe. And that's going to fluctuate and go up and down. We still don't have any kind of deal with with Europe or Japan. And the point I think we need to keep in mind is that at the end of the day, these are not, the most horrendous levels, but there are levels which we haven't seen for, certainly since the Second World War. So, 70, 80 years or so. And let's just see how the market's going to react to that. But I think at the moment, the market is, starting to focus back more on the Fed and the data. And we shall see. And of course, we have earnings seasons coming up in July. That might be the next big catalyst as well. Okay, the other thing as well to be looking out for is the auction. So let's just look at a few market reactions here in a few charts and just see what's going on. We had a pretty strong 10-year auction yesterday. We have the 30-year auction today at 1 p.m. So as I said, the 10-year auction went pretty well yesterday, also as did the 3-year auction on Tuesday. So once we get through this 30-year auction today, maybe that could be, some pressure taken off the long end of the curve and it could push up. So let's just see, look what's going on. So we had the VIX The VIX up just a little bit yesterday, and that was probably just on a bit of a move down in the ES. You see the ES here sort of spiking here. And interesting that if you look at this sort of Fibonacci measured move, extended move, it sort of got about halfway through up there, couldn't make a new high. Again, this is still a bullish chart, but we are starting to see some signs of maybe some sideways consolidation, which would actually be natural for this to pull back maybe to like the 50-day moving average or even the 100-day moving average, or even just like a basic sort of fib retracement. That would be normal. But the point is, yesterday there was sort of a bunch of news stories going around that the Americans had asked various members of their sort of military and diplomatic corps just to sort of move from the Middle and Middle East and some of the Gulf states, indicating a potential strike. And we've been seeing over the last 12 months, 12 hours, sorry, quite a lot of headlines saying that there's credible intelligence that Israel is possibly preparing to hit sort of Iran's nuclear facilities in a preemptive move. Now, obviously, that's going to be a bit of a risk-off move, so that could be part of that. That also could explain why the VIX is up a little bit. So let's just see what happens and see if there's any follow-through. Of course, big move there was oil on that. So if we look at oil here, you see that oil yesterday, this big green candle spiked up. I found some resistance here. This is the WTI. I found some resistance here at the 200-day moving average, and probably also on the fact that there's no strike has yet happened or any indication of retaliation by Iran or anything. So you see here that oil's given back quite a lot of that there. But still, nonetheless, what's interesting is just to look at just some of the mechanics of the oil market, and we can see that yesterday, for example, if you look at the most active options, which I think we've got here, where we've got the most active options, maybe that's here. Yeah, if you look here, you can see that there was quite a few sort of calls bought, and even 100 strike 100 calls, so quite heavy volume there in some upside calls. So that's kind of interesting. But if we then go and let's look at some of the sort of indicators here. You can see here that the call put sort of the skew. You can see yesterday. This is a 60-minute chart, so you can see here the price of the calls ripped much higher than the puts, and so in quite an unusual situation that the call put skew was actually sort of in positive territory. It went up quite a lot there. So you see up to a level of about 7. And if you actually go back, just to give you a bit of context here, if we put this on, let's say, I don't know, a yearly, we'll go back, no, sorry, a daily, go back, let's say like a year, just to see that this is actually quite an unusual situation. It only happens in moments of quite a lot of tension. So you can see normally the call put skew is actually to the negative, so people paying more for the puts. But you can see here yesterday we actually got into quite unusual territory there, indicating a bit of tension in the oil or in geopolitics, which of course is a positive for the oil price. If we also just look at the very front of the curve, the CL1 to the CL2 sort of prompt spread, you can see that the prices are going up, the outright prices, but also if you have a look here on a 30-minute chart this time, you can see that the spread is actually sort of pushed higher up to about $1.32 yesterday, so grinding higher. And then finally, if we just look at the curve itself, we can see where we are. This is right now is the white line. So you can see pretty strong backwardation. And this is compared to 1 week ago, which is the orange line, which also is in a backwardated form, not quite as much, but you see there's been a big move in the outright. Although if we go back just to 1 day, you can see here, which is this sort of light, sort of purple color. You can see that actually we've come down in price. So as I say, just the price reached its overnight tension about sort of 7 or 8 p.m. last night. It's coming back down. So let's keep an eye on all the headlines for oil. Again, just getting back to some of the charts here, we can see that if we look at something like the 2-year, let's just look at, or even like the SOFR. So if we look at something like December 25, you can see the SOFR yesterday, they pushed up quite a lot higher. If we look at the ZT, the front end of the curve, it's had a couple of pretty solid days on the back of that sort of weak CPI, and probably some of the geopolitical risk coming out of Israel and Iran. And that's reflected also in the 10-year. You can see that's a pretty strong, a combination of a sort of a thought that maybe the US economy maybe is starting to show the first cracks of a slowdown, and potentially also some geopolitical risks. That's all across the curve. If we look at the currencies, just with that lower sort of CPI yesterday, you see the US dollar breaking down quite significantly. So this is yesterday, this red candle, and we can see today we've actually broken down quite substantially, and we're now testing some pretty important levels, obviously way below the 100 level, but we're getting back to this level, which we haven't been to March 22, which we also touched back in April, a bit, a couple of months ago. So this is quite a key level here because, as you can see, all the moving averages are still pointing downwards, momentum downwards, and it's a pretty clear break. If we break this here, really the dollar bulls, if there are any, will have to sort of basically rescue this now. So let's see if there's follow through. Is this just something sort of poking its head below, and will we get a bit of a reactive bounce? But we already had this. And essentially, we can say that this failed at the 50-day moving average. It failed at the fib level. So this is a very critical moment here. And if we get soft data this morning, this absolutely could break through, and that could really cause the next leg down in weakness. That, of course, is being sort of echoed by on the parallel by the strength in the euro. We see the euro here. It had this sort of retracement, this sort of a bull flag thing here, and then just sort of grinding higher, and then suddenly ripping higher. Now we have the next little bit of resistance at about 116.8 or 116.80 or 90. But then after that, we have pretty clear skies. So euro looking quite strong here on all the cross pairs. Looks like there's a lot of flows going out of the dollar into the euro. We're also getting some safe havens. We're seeing the franc here. You see the US dollar breaking down against the Swiss franc. The next level down there looks like it's about 80 cents, 80.30. Again, the Swiss National Bank will be interesting. They're not going to love this sort of continuing strengthening of the Swiss franc. So that's something to be looking out for. But it's difficult at this point where you have structural reasons to be short the US dollar, and you have maybe geopolitical reasons, safe haven, to be long the Swiss franc. So that's causing that to have quite a bit of a bid. Japan also, the Japanese yen also strengthening, not as strongly as the franc or the euro. But that's coming now. That looks like it's pushing down. We do have this sort of slight uptrend here. As you can see, the moving averages are more or less, except for the 20-day, which is a little sideways, but the others are still pushing, weighing heavily. So if this breaks down, I mean, for sure, this could test down next at 142. And then if that breaks, the level, of course, this really monster level down at 140. On the other hand, some of the more the risk currencies, if we look at the Aussie, grinding up against the US dollar, but not nearly as strongly as, let's say, the euro or the Swiss franc, and to a lesser degree the yen. But overall, weakness in the US dollar. And just finally, to look at at gold, you see gold enjoying this sort of weaker US dollar, a bit of geopolitical risk, and sort of the possibility that the Fed might be inching slower towards sort of rate cuts. So gold continuing to had a little bit of a pullback here, but looks like it wants to push higher. Then we have silver, which did have a pullback, and let's see if that follows gold. We know also platinum absolutely ripping at the moment. So interesting to see what happens with gold and then silver. And if you look at copper, again, on the risk-off tone and the lack of, sort of serious trade deals and tariff negotiations, copper just pulling back a little bit. I'm not saying it's down and out, but definitely lagging the other metals. Just finally, want to have a quick look at the curves here. You see a bit of steepening yesterday as those front end yields came down quite a lot compared to the back end yield. So we had a bit of a bull steepening yesterday. Not huge at this point. Probably we'll need to look at the data. This is the 230s. We'll need to be looking at the data this morning. So that's it, guys. I'm going to wrap up there. As I say, it's importantly to look at the initial jobless claims, continuing claims, and also to see if the PPI today sort of confirms in any shape or form the slightly weaker CPI from yesterday. Otherwise, we need to keep an eye on headlines definitely coming out of Israel and Iran, especially for the bond market, and well, I should say also equities and oil, obviously. And then, of course, let's see if there are any trumps coming from our friend in the White House. Thank you. Have a great day.